Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 10, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Markets are interesting. There's a lot of divergences out there that we're going to discuss tonight, so I think you'll find what I have to say interesting, or at least I hope you will. So here we are at the SPDR with the SPDR, and we're below the 226.59 again. So I believe that number to be important. That number is important in my book because it happens to be the pivot high. 226.59 was the high of December 28th. It's not the only reason, but one of the reasons is because it happens to be a failure point of the market, and that's one of the reasons why it's a critical number for me. And the fact that we cannot close above that level and confirm is concerning for the upside. But there's a couple of things going on here. We are making what can be a bullish pattern. We're going sideways and we're above all the moving averages. So technically speaking, there's nothing wrong with the market. It's still in a technically strong position, and we certainly can go higher from here. However, in my view, the fact that we cannot sustain a close above this level tells me that it's a failure zone and that we're going back down to retest some other levels. Now, let's just say that that is the case for a minute. What are those levels? Well, I've got one on the chart identified at 224.66. That's a level that I think the market will come down and test in short order if I'm right. Any close below, in fact, even on an hourly basis, below the 20-period moving average, which right now comes in at 225.87, any close below hourly and then daily below that level brings into play 224.66. And I would say in rapid fashion, I'm not looking for the market to work its way down there. If we start selling and we begin to see hourly closes poorly and then a close below 225.87, which really isn't that far from where we are now. In fact, this morning's test was about 226 on the low. The low today was 226.01. So if we can begin getting hourly closes down in that zone, then I think in rapid fashion we go down to 224.66. Now, am I saying all in one day? No, that's not what I'm saying, but would we get there by early next week? Yeah, for sure, in my opinion. Now, if the market gets below that level and closes hourly and then daily below that level, there are lower levels, and I've got one identified on the chart, but this is a long way off, 219.56, and it happens to coincide with a couple of things. So the 219.56 comes from a mathematical number that I derived using a formula that I have. The second thing is, what I like is the fact that that happens to also be at these former pivot highs, which proves that the market finds that price area important because it had trouble getting through there and was rejected from that level, but it spent quite a bit of time consolidating up in the zone. So the mathematical number comes in at 219.56, and ironically enough, it happens to be right in this zone at these highs. The other thing I like is there's a gap fill, and the official gap fill comes in at 219.68, and interestingly enough, unrelated to the way I figured out the 219.56. So I've got two additional things that I guess I could call them pieces of evidence that if, and I'm only saying if, right? Well, I'm not saying the market's coming down here anytime soon. I'm just saying if we did begin to get down into this zone, that's a buy it with both hands type of environment. And if we do begin to sell and sell hard, we'll obviously talk more about that area. But there are plenty of other support areas in between 224.66 and the 219.56. But I just wanted to bring that to your attention. I'm going to leave it on the chart for a while. You guys know that I like to do that. I like to find a level and I'm going to be early, but I'm also finding a level that I believe the market will get to, and it will also have a price reaction from, and I believe that with confidence. Might take a while, but that's a number nonetheless. All right, let's get back to some interesting stuff. I'm going to go down to a 10-minute chart, excuse me, and I want to point out that obviously you see the market trading in and around the 226.59 area, and so this is obviously an important price area because the market continues to trade in and around this zone. But what I find interesting is if you look at the market this afternoon from around 2 o'clock up through toward the last half an hour, up to the last half an hour of the trading day, the market was trading up. We traded up into this level, and what you'll find interesting is where did we peter out? At this red candle high, which was at 226.94. The high here is 226.96, and the market was rejected from that level. That's because of this red candle high. That's the way the market works. It would need more time to consolidate to get through that level. So by the way, how many candles did it take to get up to that level? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, into a red candle high, into a moving average, 10 candles up. That is ripe for a shorting opportunity, but that's not what I wanted to bring to your attention. And while that's a chart lesson, that can be applied to hourly charts, daily charts, weekly charts. It doesn't make any difference. That's a chart pattern that will essentially work on basically any time frame when you have these type of conditions all converging at the same time. But what I thought was extremely interesting was what the market did in the last 20 minutes of the day. In the last 20 minutes of the day, the market traded down and closed below the 226.59. Now, most people wouldn't give that a second thought, but because that number is important to what my work tells me, I find that extremely interesting, and I find it somewhat telling of kind of a shot across the bow of what's to come. 2 days in a row, we had a failure and closed below that level. So I find that curious. I find it interesting. So right now, my bias is to the downside if I had to pick one. But let's look at some other things because there are some divergences out here that need to be watched and are of note. Namely, the IWM. Let's go over to the IWM, the daily chart, and let's take a look at what we've got first, and then we'll go down to a shorter time frame. So like we've been talking about, there is no mistaking the fact that this is a bullish pattern all in all. Okay, it's a bullish consolidation pattern. But we've been going back and forth in this area for quite some time. And so all today was an uptick into the 20-period moving average, and we also came close to the upsloping trend line that's drawn over from the monthly chart. And remember, any month that we close above that level is going to be an important price level for the IWM. Remember, we closed below in December. We threatened it and closed below in December, popped up one time, and 3 days worth of a sell-off so far. So here we are into the 20-period moving average. Obviously, if my bias is to the downside in the short term based on the spider chart, then I would think the IWM would follow. However, here's where our divergence exists. Look what happened today. The IWM was up almost 1% and the spider was flat. So the last few days we've had a divergence with the NASDAQ being up, and now we have the IWM strong. And the question is it a one-day wonder or is it foretelling of what's coming in the spider? And my bearish bias should actually be bullish. We're going to find out in short order, but for now we have a divergence, and that has to be just at least of note. Let's go over to the transports because we have another divergence. We have the transports up again today over 70 points, but all in all, all we're really doing is continuing in the same bearish pattern that we have been. We talked about it last night. Yesterday was a down day. Today was just a reverse of yesterday. Really nothing more, nothing less. So you can't make a whole lot out of that. It's just a bearish pattern that's continuing to develop. The longer it goes sideways, the more prone it will be to go down. However, you do have this safety net of the 50-period moving average upsloping. So as time goes on, this will actually move into the transports unless they break beforehand. Let's take a look over at gold. So gold is kind of creeping its way higher, seems to want to creep into the 50-period moving average. If it breaks through the 50-period moving average, I think your upside is 1200 to 1205. I don't really see much more upside from here at this stage. That's not to say we can't go higher later, but I think we would have to have more of a consolidation. I would rather have seen gold consolidate down in this area here for a few more days and build some more energy for another move higher. I don't like the creep higher because the creep will ultimately peter out. We'll end up going back down to the same place that we should have consolidated in the first place. But right now, if we can get a daily close above 1190, I think that we just go pretty much to 1200. It's too close to 1200 for us not to get there if we get over 1190 on a daily chart closing basis. Silver was also up today. It came into the 50-period moving average and backed off slightly. We know that this level is going to be difficult for silver to get through. This is kind of a make it or break it time. Either we consolidate below that level and then it will be easy to get through, or we're going to have more of a pullback and more of a, I guess, bullish wedge pattern. But a rejection from the 17 level will most likely bring us in silver back down to somewhere in the vicinity of 16 and a quarter, appears through the 20-period moving average. There's just a lot of resistance in this zone between 17 and this other chart consolidation up here. It's just a tough area for this for silver to get through without consolidating for a while. We've already been up a lot, so it's unlikely that we just bust through right to the 200-period moving average. Just typically doesn't happen like that. Let's go over to crude. And crude had another down day today, and we have a pretty weak crude market right now. We've been talking about 51.50 and 51, and we cut through both those areas. Let's go down to the we'll go down to the shorter time frame, the 10-minute chart real quick. You can see here we didn't even flirt with 51.50 for that long. Came down, consolidated over it, busted through, tried to recapture it. You can see here, we tried it from the underside, and then the failure right down to 51, and at the close, they hammered them into the close when the pit session closed, and now we're making a bearish consolidation. So, maybe a dead cat bounce for a while, but all in all, weak market. Most likely, if we stay weak, you're going to have some support here at the moving averages, but I think the number that they're going to want to get to is 49 or lower, 49, 48. That's the zone that becomes a potential buy area. And if we're getting any kind of a sell in the market, you can see where crude oil would get hit on the downside, and we'd see those levels pretty quickly. So I wouldn't be interested in a long trade in crude oil at least before 49. That's at least today's information. Let's go over to the bond market, and we're consolidating and staying above the 50-period moving average, which is a bullish sign for the bond market. The question is, can we get through 153? We came up just short of 153 today, with the high being 152.31, and so we were one tick away from 153, and the more we consolidate beneath 153, the more likely we are to get to 154.02. It would just be a chip shot away if we consolidate for another couple of days. Let's see what happens. If we do get a sell in the market, that would be most likely money flowing into the bond market, driving the price of bonds higher and rates slightly lower. Keep in mind that a couple of things going on over the next couple of weeks. Not only do we have Martin Luther King Day next Monday. That's generally a turning point, not necessarily that day or the next day, which the markets close that day, but not necessarily that next day, but that tends to be a turning point a lot of the time in and around that holiday. We also have the inauguration coming up. We also have the Fed meeting, which they could potentially raise interest rates. Now, they'll only raise interest rates if the market, the stock market, is higher. So that's another interesting dynamic that's going to take hold and play into the scenario over the next couple of weeks. Because if the market sells into the Fed announcement, they'll probably shy away from raising rates and kick the can down the road. So we've seen that happen time and time again when the market sells into a Fed meeting. My point in saying if the market, stock market-wise, is selling, that would generally mean higher bond prices, at least in the short term. That's generally what we would see. We would see money flow out of equities into the bond market, theoretically driving the price of bonds higher and yields lower. But with the Fed meeting on the horizon, it will be an interesting phenomenon to see which way this market goes, meaning the bond market. Either way, if we consolidate for a while longer at this level, then I may be interested in a trade to the upside. We'll see. I've got my eye on the bond market. And we'll wrap it up on the dollar tonight, which is at 102 even as we speak. We're making a bearish pattern, so we may not be done with the downside in the dollar just yet. I think they're going to want to get back down to par to retest 100 cents on the dollar or lower, and then I think we'll firm up on that and see another leg higher. And with that, I'm going to wrap it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.